Well, hello again, everybody. This is John Norris at Trading Perspectives. As always, we have our good friend Sam Clement. And today we also have a special guest, Grace Schlenker, who is going to be a rising senior at Auburn University next year. Is from Arizona and has been an intern all summer long. She's joining us here today. Y'all say hello.
How's it going?
Hey, happy to be here.
Hey, guys. We're happy you're here today, too, Grace. And, the reason why we're happy is, well, we've had a great summer with you. It's nice to celebrate here at the end of your internship, and here we are also at the end of the dog days of summer. Sam, I'm not sure if you knew this, the dog days of summer are actually July 3rd all the way through August 11th, which are supposed to be the hottest days of the summer.
I think it's been pretty accurate so far.
It's been boiling, but Grace is from Arizona, where it's hot all the time, but it's a dry heat, isn't that right?
Completely different. The humidity is almost worse, in my opinion.
It's not almost worse. It is a lot worse. But this year, when I'm sitting there thinking about everything that's gone on this summer, it seems as though the dog days of summer really, at least symbolically, kind of happened in August. Because, Sam, Grace, July was a pretty good month for the markets.
Yeah, it was a good month. And then it seems like something kind of changed on the dime, and everything seems to have been slightly negative at least.
A couple of weeks ago, we talked about how changing climate patterns or the oppressive heat was going to change consumer expenditures, change how people were spending their money, how they were living their lives and conducting business. And I mentioned at the time, I said, just like people aren't going to get out of their cars, they're not even going to get out, and they're going to bring their lunch so they don't have to get out during the middle of the day. So Grace was not here. Courtney was still here when we did that one. Grace said the oppressive heat that you enjoyed this summer in central Alabama, did that change anything that how you lived your life or conducted business here during the dog days of 2023?
I don't know if the heat affected it more so as the 9 to 5 that I'm not as adjusted to.
Okay, and the low pay.
Yeah, but I definitely could see with the heat, even just the eating out and everything, was more likely to just drive home during the hour lunch break, go get some lunch that I got from Trader Joe's, something like that.
And Sam does that every day anyhow.
Every day.
Absolutely every day. So we had the heat, oppressive heat during July, and truthfully, it was the worst I can remember in my life. Truthfully, I just don't remember heat indexes being 110.
Climate change.
Climate change, without a doubt, or maybe some doubt. I don't know. It was just hot. And then also this summer, gee whiz, we had, what was that? Moody's downgraded, Fitch downgraded.
Fitch downgrading U.S. debt.
And something, we sit there and took a look at it. It's been all the way back to 2011, Grace, when S&P 500, not S&P 500, S&P, Standard & Poor's, downgraded U.S. Treasury debt all the way back then, and the markets freaked out. I tried to take vacation on that week that they did that, and the markets were falling apart. I had clients calling me over in South Carolina. I had reporters calling me, and it was just a mess. Sam, how did the markets respond this year with that?
Well, they were pretty fine for the most part, I think. It was convenient timing, and we talked about this already with the other kind of bad news of close to $2 trillion of Treasury debt being offered in the back half of this year.
Well, bad news? What are you talking about? That's money as though from on high.
Good news for some people, I guess. Good news for the Treasury. But, those kind of lining up, and the market didn't seem to like that more so. It seemed fine with the downgrade, and we talked about that kind of ad nauseum last week or the last couple of weeks. And so, it seemed fine with that, but overall it seems like the negative news sentiment just continues.
Now, I'm of a certain age, and that age might be double nickels, also known as 55. So in 2011, I was already a man of some certain years. In 2011, you would have been 15, and you were probably on the swim team in the summer of 2011. Do you remember any of that at all?
I was 10 years old at the time, so I really don't think that I remember a lot of that.
You weren't paying attention to Fitch ratings? And,
no,
all that
I don't
stuff?
think that was the top priority.
Well, how about this today when we're taking a look at what Moody's did today, and the reason why the markets are off as much as they are. We're recording this on August the 8th of Tuesday. We're going to drop this onto the platform tomorrow. You take a look at what happened with Moody's today, and Moody's downgraded a bunch of banks due to higher interest rates. Sam, why and why now?
Well, it seems like that to anyone in the markets could have gone without explaining. Obviously, what's happened over the last year, we've seen some banks default and go bankrupt, what have you. I don't know what new information we're getting out of this at this time. I think it would have been one thing if they did it before all of the bank issues happened in March. But it kind of seems like it's after the fact now. kind of stating the obvious.
Well, I mean, we're taking a look at it. Of course, it's stating the obvious, in my opinion, which is kind of the reason why I'm going, why are the markets responding so strongly here today? This isn't anything, this isn't like, oh my gosh, quantum physics. This isn't Oppenheimer. You know, this is, okay, interest rates go up, bond prices go down.
Yeah.
I mean, you've learned that in finance portfolio management down on the plains, and that's exactly what's happened here. You know, Silicon Valley and all the other ones, Signature and what have you, we could say that, okay, yeah, they had some problems with the bond portfolio, but it was really balance sheet mismanagement that caused those banks to fail.
It's 100% what it is. It's kind of picking pennies up in front of a bulldozer, is it called? You know, trying to juice out a little more yield, and, you know, the second things go wrong, it's catastrophic, and those pennies don't look like it was worth it. But the only banks we've seen have significant issues are the ones who were poorly managed before getting into this, before the Fed started hiking rates, and just really made really poor bets.
You know, before I get on and kind of wonder why the market has responded so strongly to Moody's today, I'm going to have to take a little bit of an aside and ask Grace, who's sitting right here. Again, she's from Arizona. Has gone to Auburn now 3 years, going to be 4 years, spent some time in our state. Do people in Arizona, your section of the country, do they use expressions like picking up pennies in front of a bulldozer as often as we do here in the South?
No, I think that's the first time I've ever heard that one.
So is there any sort of an equivalency that you can think of in the Phoenix Metroplex?
That's a great question.
I don't think terms like that are used very often anyway. So.
I was about to say, I don't know if they use kind of those phrases as often. People just kind of state it how it is.
I happen to like. I've never heard that one before. I happen to like it. But, you know, today, watching the markets kind of fall apart, bond markets rallying and what have you, you have certain banks, I think M&T just completely fell apart. Some of the smaller ones that Moody's really downgraded. And I'm sitting there watching it going, this isn't news to me. And granted, it's because I do this every day for a living. I do this for a living. Everyone knows that bank balance sheets, you've got some compression on capital. There's no way you can do it. Bond portfolio goes down in value. That means the asset side of your balance sheet goes down. If your liabilities stay the same, guess what? Your capital shrinks.
Right.
Banks lend money based on their capital base. And while it's not a perfect ratio, Grace, you can think of maybe as much capital as a bank has, multiply that by 10, and that's about the size loan book that they can handle. So $1 billion in capital, $10 billion loan book, something like that.
Fractional reserves.
Yeah, there you have it. So it's no surprise, at least not to me, that, hey, we're sitting around talking about this. We're seeing loans and leases kind of dry up, and in truth, we have. According to the H8 report, which I know you read every Friday before you go to Skybar and what have you, and all that stuff, you pull out the H8 report and you see assets and liabilities on bank balance sheet, comes out every Friday afternoon, all that good stuff. And what we're seeing, and I have seen, Sam, if I'm not mistaken, really since about the middle of March, loans and leases have just absolutely stagnated.
Yeah.
And so this wasn't a surprise, nor is it going to be a surprise moving forward. I just can kind of wondering, again, why now?
Well, this, to me, you know, again, I don't get who's really trading off this kind of news, and it also seems like the analyst who put out a new price target after an awful earnings or after something awful happens.
Isn't that amazing? It's kind of like, how do these people keep their jobs?
You have it as a buy rating until they fall apart, and then you switch it to a sell rating and put a lower price target on it. And it's kind of like that.
It seems like a pretty easy gig, doesn't it?
That would have been a lot more helpful before the fact. Same thing like this. If they started downgrading the banks last year or last summer when rates were rising and the clear impacts of how that impacts banks was put into their forecast and not after the fact. And
hey, listen, it's not just banks; it's everyone.
Now we had more, bank failures than we had in 2008 in terms of market cap.
Well, I would say it is a little bit different. Market caps are now a little bit larger than arguably they once were. And I would tell you what's a little bit different about this one is in 2008 and 2009, you could say that the weakness in the U.S. financial system was largely in your larger banks and your money center banks. The smaller, more regional, there was plenty of problems. Don't get me wrong on that. But you saw a lot of sickness in the money center banks. I think systemically important banks, the too bigs to fail. Now those banks really aren't in any significant problem, but they're is a concern that about, was it $1 trillion worth of commercial real estate debt is coming rolling off next year, and a lot of this is made at kind of the super regional level, and the wonderment is, or the concern is, banks won't be able, people won't be able to pay the higher interest rates and all that, and everything's going to go belly up. Sam, do you think that's really going to happen?
No, I do. Again, I think that worst case economic doom and gloom isn't going to happen, but it's kind of, again, trying to forecast out like Moody's and Fitch should have done earlier. Higher interest rates, a lot of these have kind of either bullet payments or floating rate, maybe some kind of arm to it or something, that higher rates. And when you plan on trying to refinance, and a lot of buildings were bought off the ability or the plan to sell it after a few years or refinance it after a few years.
Kind of flip it or...
Yes, and that's not the case. You can't do that right now.
No.
Or at least profitably, you can't do that right now. So there's 100% there's gonna be issues. Again, I think it's the kind of like looking at good banks versus bad banks and how they're managed. You got to look at who's actually managing it, what the plan is, and you're seeing a lot of people, I think, actually capitalize on times like that.
Well, that's when you have your vulture investors come in and to find some properties, what have you. Any number of the people that go out and buy failed malls, and they do that sort of thing. I do also think that probably this go around, banks are probably going to maybe be willing to work a little bit more, because no one wants to be sitting on those shopping malls and office buildings and all that stuff. So I think that's the pain is going to be shared a little bit more. Because I remember back when I was, still at my previous employer, I was talking to the CEO one day, and he said, "John, we'd love to make real estate loans, but we don't want to be in the real estate business, if you catch my drift."
They don't want the keys handed back to them.
No, they don't want the keys handed back to them. So anything that they can do to keep from having that happen, I think the banking system is probably going to do that. And that could be part of the concern that maybe Moody's had, is they're either going to be eating it or they're going to be sitting on it. Either way, it's going to zombify a portion of their balance sheet over the next several years.
But it is worth noting that talking about real estate and possible problem real estate loans, the percentage is much, much less at these important banks, the systemically important banks, than it was in 2008. We've talked about it, some of the good that's come out of 2008.
Yeah.
There was a lot of regulation that was probably overdone.
We don't... We'll deny it if you ever say we said it here at Trading Perspectives, but yeah, you're right, Sam. Some of the regulations and what have you really did help out.
So even if real estate is kind of in a bind, and it's not in a 2008 bind, I wouldn't say. Yeah. But even if it is, outside of maybe some office only real estate, what have you, it's not the same problem. It's not a 2008.
I would agree with you on that. In 2008, the whole system was doomed to fail.
There was banks with 30, 40, 50+% of their loan portfolio in commercial real estate.
Well, actually, if I remember correctly, that same H8 report was telling me sort of right before the levee broke. That's real estate loans were made up over 50% of all loans and leases on bank balance sheets across the United States. And that number is close to about 32% now. Well, still, that's still pretty significant a portion. It's nowhere near the weighting that it was before the levee broke back in 2008 and 2009. So that gives me a little bit of hope. And then also, to sit around and take a look at it, the whole system was rigged back then. Mm-hmm. The ratings agencies were rigged. The federal agencies were just pumping stuff out. And as long as Wall Street could package this stuff up and sell it to someone, all that, people were going to do it. And it was real easy, just as an easy money machine. And obviously hindsight's 2020, all you had to do is take a look back and go, it wasn't going to be a question of if, it was a question of when.
It's like hot potato with these portfolios of loans.
Yeah, it was.
Grab it, package it off, and send it off to someone else.
So, at some point, it wasn't a question of if, it was a question of when, and the subprime started showing some signs of it, and then all of a sudden, nothing could get a bid. And then it was a death spiral after that. Now, the whole system's not rigged up like that. You have some rates there, and then there's stuff and what have you, and there are some keys that are being turned over, but the whole system's not based on flipping commercial real estate, at least not in my opinion, anywhere close to what it was back then.
Right.
And so when I sit there and take a look at it, I go, all right, the market's responding really negatively here, and I've got to just think that, Okay, Moody's came out and stated the obvious, at least in my opinion, stated the obvious. It's got to be the dog days of summer.
Yeah.
I mean, it's just got to be the dog days of summer, and just really kind of, hey, July was too easy. It was just way too blankety blank easy. I'm going to take my marbles and I'm going to go home, and this is a good excuse
I
for
think
it.
that's absolutely it. You know, markets look for a reason to sell, oftentimes, and we talked about it. How the Dow broke a 40-something year record for days that were green in a row. Just looking at candlestick charts of really any indice you want to, and it's pretty much gone straight up for most of the year.
Yeah.
So, especially the rally going into this, the Treasury issuance, the downgrade of the U.S. debt, which I think was lesser of a part of it.
Yeah.
Add this on top of it, and the market had been selling off. Yesterday was obviously a great day, but had been kind of in this short-term sell-off.
Yeah.
And so it's just adding a little bit onto that. I think it could have been one of 1,000 things announced that would have maybe pushed the market lower today. And obviously banks are going to lead the way when banks are the ones being downgraded, but the whole market's really selling off. It's a not to get too into the weeds, but it's a 80+% down day. Everything's selling off.
Yeah. Well, I got to tell you, if it were a true calamity, in my opinion, you would see corporate spreads just widen out like nobody's business.
You're not.
And corporate spreads, Grace, are when corporate bonds relative to like say Bank of America's benchmark 10-year right now, it was issued back in April at a spread of 186 basis points to the then cash 10-year Treasury. Nerdy stuff, I admit. It's actually tightened up since then. And today, when we have all these downgrades in the banking system, that 10-year benchmark Bank of America relative to that Treasury spreads widened 2.5, 3 basis points.
Nothing.
I mean, for all intents and purposes, nothing. If it were truly a financial system, that would have been mushroomed out 10, 15 basis points today. But a relatively easy to digest 2 or 3 basis points, that right there tells me that investors truly, the people the smart money behind the scenes, aren't freaking out over the Moody's downgrade at all. When we get those corporate spreads pop out, that's all of a sudden when I start to get worried. Sam, your thoughts?
Yeah, and it just, I think, goes back to you can't really you make a narrative out of one day in the stock market.
Well, I mean, in terms of making
you can if you want, but I don't think it's a good narrative.
I agree with you on that. That'd be a short story, I think, a one-day narrative. That's bad, wasn't it? That was a dad joke. One last thing I want to cover really about dog days of summer. It's just like, how the mighty have fallen with technology stocks this month. I mean, we've all seen it. Grace, I want to get your opinion as a soon-to-be rising senior in college. What goes through your mind when you see like Apple down 9% in the first week of the month? Are you sitting there going, is this crazy what's going on? Or is it just, oh, well, they're just giving some back?
Yeah, I think currently, right now, we've got our little investing competition going on between the interns. So my first thought is that Apple going down helps me out in the competition. But second to that,
who has Apple?
Grace. Yeah.
Really?
I believe so. Yeah, Cody and I both have Tesla. Not Tesla, Adobe, sorry.
Yeah.
So that hasn't really been working out great for us either. But yeah, I think I'm kind of with you in the same boat. Like when you see technology crash, I think a lot of people, at least college students, they kind of default to technology when they're looking to start getting into investing. It's kind of, the safe bet, Adobe, Microsoft, everything like that. So when those start to crash, I think it starts to put a little bit of worry in the mind of people, at least early on in their investing path.
Sam, what do you think about that?
There's definitely a recency bias, and recency can mean several things, but I mean, for the last decade plus, technology has been what's worked out.
You're absolutely right on that, and it's kind of funny when Grace was mentioning that. You're talking about Adobe, Microsoft, things that just make you feel safe. I got into the industry in 1991, and back then, the names that made people feel safe were IBM,
Probably GE,
and General Electric. Those are names that people of Grace's age, you have no more, you wouldn't buy that at all.
Yeah.
You just wouldn't have anything to do with it. But those were the rock solid. You have a trust portfolio, a widows and orphans account. You had IBM, you had GE in it. Now you can't even find that stuff. And you're right, those tech names, a lot of those are now perceived to be safer than a lot of like consumer staples and the like.
Anybody under the age of 35.
I don't know any of them.
I'm saying,
outside of you two.
Anybody that's investing in their working career, 35 or younger, has made more money by investing in tech and growth stocks.
That's
almost exclusively.
That's where their earnings have been. That's where the growth's going to be, because a lot of these are not just constrained to the United States. They truly are multinational. Not to say that IBM and GE weren't, but I don't know if they're getting 60-70% of their sales from around the world.
Yeah.
So the U.S. can be down, the U.S. can be in a funk, and get some profits from elsewhere. So I guess you can maybe blame the recent tech slump also on the dog days of summer. Trying to get it all in here in about a week and a half in August, because July was so good.
Yeah.
It is cooler today, though.
A little cooler.
A lot cooler today. Well, guys, we always love to hear from you. Also, if you have any questions or comments, please, by all means, let us know. You can always drop us a line at tradingperspectives@oakworth.com, or you can leave us a review on the podcast outlet of your choice. As always, if you're interested in reading more, hearing more of what we have to say, what we think, you can always go to oakworth.com, take a look underneath the Thought Leadership tab, and find all kinds of exciting information, including links to this links to previous episodes of this podcast, as well as links to our blog, Common Sense, and also our quarterly magazine, Macro and Market. With that, any more comments on this topic today?
That's all I got.
That's all for me.
All right. Thanks a lot, guys. Y'all have a great day.